In this video, we have the Chapter 3 and 4 examples for cost accounting, AC 323. So Chapter 3 talks about cost classifications, and we talk about what are fixed costs, variable costs, mixed costs, direct cost, indirect cost, period costs, product costs. So in this example, we're looking at two amounts, and we want to identify them as variable, fixed, or mixed costs. So what we know is fixed costs stay exactly the same regardless of level of volume of activity production within a relevant range. Variable costs increase directly in proportion to production. And mixed costs have a component of both fixed and variable. So when we look at each of these costs, we want to identify which is fixed, variable, or mixed. In Department A, we have $10,000 both months, even though we doubled our unit production. So Department A's costs would be fixed. In Department B, we double our costs with the doubling of production. Department B's costs are variable. Department C raises $10,000, but it's not in exact proportion with production in the same way that Department B is. So Department C's costs are more than likely mixed. Department D is similar. We do increase costs, but it's not an exactly proportionate amount. So Department D is also mixed costs. Department E is an exact doubling of cost with a doubling of production, which tells us that Department E has variable costs. The other problem that we're going to look at in Chapter 3 is the creation of a statement of cost of goods manufactured and an income statement for a manufacturing company. You might remember making a statement of cost of goods manufactured in Principles of Accounting 2, but it's probably been a while since you've made one of these statements. So we're going to go through an example. In this example, we have manufacturing costs for us. We have information about our company. We're a manufacturing cable company. We have a strong portion of information about the kind of costs that we have. And then we have other information about our company. So all of this additional information. We have a statement of cost of goods for April, and we have inventory balances for the end of May and depreciation expenses, in addition to our end of May closing accounts. So the first thing that we're going to do on the statement of cost of goods sold is factor how much our materials used in production were. We start with beginning materials inventory. So we want our materials inventory as of May 1st. So we see here, direct materials inventory as of April 30th was 28,000. So 28,000 is our direct materials inventory. I'm going to format these cells to be numbers. We then add our materials purchases and our freight in. So we look for our purchases of direct materials. We see 510,000, and our freight in 15,000. So materials purchases of 510,000 and freight in of 15,000. We add those together, and that amount is our materials available for production. We subtract our ending materials inventory, and that tells us how much materials we used in production for the month of May. So if we go up here, we see that our inventory on May 31st is 23,000 for our ending materials, 23,000. So our direct materials used is our direct materials available minus our ending inventory. The next item that we need is direct material or direct labor used. So we want the amount of our direct labor cost. So we see here that we have direct labor of 260,000. The next cost that we're going to calculate are our factory overhead. So we want to look for our factory overhead costs. When we're looking at those factory overhead costs, we might need to consider these notes. So our first factory overhead cost is indirect factory labor. So we see indirect factory labor is $90,000. The next amount we want is our utilities. We have utilities of $135,000. But what we see up here is that of the utilities, 80% relates to manufacturing the cable. The remaining 20% relates to the sales and administrative function. So 80% of that $135,000 is for overhead, and the remaining 20% goes to sales and administration. So we have 135,000 times 80%. Now our property taxes. We have 60,000 in property tax. So we look and we see that all property taxes are assessed on the manufacturing plant. So 100% of the property tax cost goes to overhead. Our next overhead amount is insurance. We see here that insurance is $20,000. We come up here to our notes, and we have a note that 60% of the insurance is related to manufacturing and 40% is related to sales and administrative. So 60% of that 20,000 is part of overhead. $20,000 times 60%. And then the last factory overhead cost we have is depreciation. We have a chart here of our depreciation amounts. Of the depreciation amounts, we have 2 items for manufacturing and 1 for office equipment. So we have $50,000 worth of depreciation that goes into overhead, and the remaining $4,000 is a period expense which ends up on our income statement. So we have overhead depreciation of $50,000. That gives us our total factory overhead, $320,000. We add our 3 manufacturing costs, direct labor, direct materials, and overhead to get our total manufacturing costs for the period. We then add beginning work in process inventory. Our work in process inventory on April 30th was $150,000. We add our manufacturing costs plus the work in process inventory at the beginning of the month. We have our total manufacturing costs for the month. We then subtract our ending work in process, which we get from our table up here. Ending work in process inventory is $220,000. So we subtract that from our total manufacturing costs, and we end up with a cost of goods manufactured of $1,040,000. The next thing we're asked to make is our income statement. So we start with sales revenues less sales discounts. Our sales revenues are $1.488 million, and our sales discounts are $20,000. So if we want to do in thousands, so this is 1,488. So our net sales is sales revenue minus sales discounts. The next thing that we're going to calculate is our cost of goods sold. We start with our beginning finished goods inventory. Our finished goods inventory as of April 30th is $247,000. We add the cost of goods manufactured that we calculated on our statement of goods manufactured. That gives us our total amount of goods available for sale. Then we subtract our ending finished goods inventory. Our ending finished goods inventory is $175,000. If we omit those zeros, we have $175,000. Our cost of goods sold is $1,287 minus $175. And our gross margin is net sales minus cost of goods sold. Then we consider our individual expenses. We have office salaries and sales salaries that we get off our chart. 122 for office salaries and 42 for sales salaries. Next, we have insurance. So if you remember when we were reading before for overhead, we had a $20,000 insurance cost. 60% of that $20,000 went to factory overhead. The remaining 40% is a period cost. So 20,000 times 40%. Next are utilities. So we applied 80% of the utilities here to overhead. The remaining 20% is a period cost, which goes on our income statement. So we have for utilities $135,000 times 20%. For rent, our notes up here say that all rent is for the office building. So 100% of our rent is a period expense with the office building, $9,000. And if you remember off that depreciation chart, we had $50,000 in overhead depreciation and $4,000 in office depreciation. We add up all of those numbers, that gives us our total selling, general, and administrative expenses. We subtract expenses from our gross margin to get our operating income. Then we have other revenue and office supplies expense. In class, we weren't sure why office supplies expense wasn't included in the other expenses, but I left the formatting the way the textbook had it. So we're going to find our other revenue, which we're going to add $2,000. and then office supplies expense of $6,000. So if we add our operating income to other income and then subtract the office supplies expense, we get pre-tax income of $140,000.